Hello, it's Friday the 14th of May. My name's Neil Shearing, I'm the Group Chief Economist, and this is your week at Capital Economics. And it's been another one that has been dominated by inflation concerns. The data earlier this week from the US, much stronger than expected, and we've covered all of that in detail on our US service. But we've also been digging into the issues on our Canada service, on our UK service, and of course in China, where we also got stronger data on the inflation front earlier this week. Our global team have been exploring the relationship between moves in commodity prices and inflation, and the extent to which that's going to exert more sustained upward pressure on inflation over the coming months and quarters. And we've also hosted a drop-in where we've looked at the comparisons between the situation now and the situation in the 1970s. And actually there's some good news there. We don't think we're going back to the 1970s. Comparisons with the 70s are, in our view, overdone. We've explored all of this from a markets angle too, and our markets team put out a note earlier this week arguing that actually the 1950s was perhaps a better guide as to what might happen for the equity market in terms of the relationship between inflation and returns on the equity front. And so have a look at that. And if all of this has proven too much for you, it's getting too stressful, well, there's some light at the end of the tunnel. Our senior economic advisor, Vicky Redwood, put out a piece earlier this week arguing that in future, we may all be working fewer hours as productivity growth starts to pick up. And on that happy note, I'll leave you and say, have a good weekend. Goodbye.